Hello, everyone. Today is Friday, October 2nd. As always, I'm your host for Collectibles and Coffee, Edward Gwynn. Beverage of choice today, black coffee, nothing too interesting. Let's hop right in. I mentioned before in the past, for those of you who have listened to some of my past episodes, I have mentioned that having an understanding of the real world, of how economics, of how finance works, of how business works, these are skills that are very, very important for anyone who wants to seriously invest, whether it's starting your own business, investing in any asset, what have you. Understanding the real world goes really far because a lot of these skills, all these principles, a lot of these ideas, they do apply to more than our small corner of the world of collectibles, of hobbies, because at some level these will scale up. A few years ago, a decade ago, even 5 years ago, 3 years ago, a lot of us wouldn't have had the idea that collectibles would be worth as much as they are now. Now the fact that there are real eyes. Yesterday, when I was talking about the state of collectibles, Mark Salzberg, his letter, he's the chairman of CGC. We're at a point where collectibles are now becoming so mainstream, people are no longer looking at it as a weird niche hobby that a very small subset of people enjoy. Now hobbies, collectibles are becoming assets. They're becoming valuable enough to a point that people are seriously considering putting their money into them over traditional investments such as stocks, bonds, the market, etc. And when things scale up like this, we start to see things trend towards real world economics, real world principles, psychology, among others. So today, the primary focus of today's episode is understanding some of this, looking at the psychology that goes into investing. We'll look at some fallacies, some easy traps that many of us in the past have fallen for. It's very, very common. There's no shame in it, but understanding it is how we can avoid doing so in the future. And if you want to be a smarter investor, no matter what level you operate on, it doesn't matter if you have $10 to invest, it doesn't matter if you have $10,000 to invest. Making these mistakes will put a damper on your investment. And by avoiding these mistakes, you can maximize your odds of being able to take your investment and stretch your money far. So let's hop right in. So one of the things that people really need to understand when it comes to the psychology behind investing and the cornerstone of behavioral finance is understanding cognitive bias. What they are is, in short, some sort of bias, some sort of action, some sort of psychological influence that affects our judgment, affects how we make decisions. There's a whole list of them. A lot of these are very well studied. A lot of these have fancy names, mainly because these are tests. There are tests that have been done by psychologists, by behavioral studies that have shown that these phenomena prove to be true. A lot of these studies, very, very interesting to read. It's really interesting to think, how can we create a psychological test? How can we create a psychological study that would prove or test one of these theories? But this is something they've done. And a lot of these cognitive biases are very well documented. They're something that are very well studied. A lot of these do have real world examples. I'll use some examples out of my past, some mistakes I've made along the way, and things that I've learned from them, and kind of the takeaway as to help you avoid falling into the same traps, avoid falling for these cognitive biases, and being able to prevent making some of these mistakes that not only have I made, but corporations, businesses have lost far, far more money than I have, or most likely you will ever. Again, understanding these is really a cornerstone. These are keys to being able to invest smarter. So in the context of investing, there are a few common ones. The most common ones we'll look at today, for the most part, these are things that we experience very strongly. That's part of the reason why they're so powerful. And most of these do actually apply in scenarios beyond just investing itself. The psychology behind investing is worth a lot of words. That's something that I can't even begin to cover in its entirety. Many people, researchers, doctors, psychologists have written a lot of words about this. I'll provide some sources, some good reading material for people who want to go out and learn more. Again, I think a lot of these, it is a little bit dry. I know some people who follow me may not necessarily care to do this, but again, I encourage you, if you're looking at operating a business, if you're looking at investing serious amounts of money, or you're looking to dabble into market more than just a casual hobbyist or collector, it's really worth understanding a lot of these real world principles and how they can stretch from their initial applications in the real world on a much bigger scale to how they may affect you on a personal micro level. So the first one we'll look at, this is probably one that most people are familiar with on some level, is the sunk cost fallacy. At its core, it's very, very basic. Most of us have a good understanding of what it is. The idea behind sunk cost fallacy is that whenever you, an entity, a business, a corporation, whenever you're putting some sort of resource into anything, not necessarily an investment, but taking some sort of action, whenever you're committing resources to it, that is a cost. That is, it may be your time, it may be your money, what have you. There is some sort of costs associated with this action. If there's no costs, then this doesn't apply. But for the most part, most of us at some level commit some costs to being able to get a service, get a good, or get an investment. So, understanding sunk costs, what sunk cost means is that if I go out and let's look at this from an investment level. If I go out and I put $100 into item A, doesn't matter what it is, it's immaterial. I put $100 into item A, that's my cost. I'm not factoring my time it took to acquire it. I'm just looking at very simply putting $100 into item A. My cost on that item is $100. In one scenario, let's say the item does well, right? I wait a year or something, it jumps up to $200, I sell it off, great. I made $100 in that time. Seems like an ideal scenario, 100% return over the course of a year, excellent. Can't complain about that. Most of the time, what's the reality of the situation? The reality of the situation is the return might not be quite as good, right? I may only be looking at getting $100, like $120, $150, small return. Most of those are fine. What happens if this $100 asset, item A, loses value? What happens if a year down the line, it's only worth $50? In the context of Magic, in the context of Yu-Gi-Oh!, in the context of Pokemon, right? Very, very simple to understand. We see experiences all the time. How do we look at this? Reprints, right? Item A, bought at $100, a year down the line, it's $50. Most people, and this is where the sunk cost fallacy comes in, most people will be inclined to say, it was worth $100 at one point, it's only $50 now, I'm going to hold on to it and hope I can recuperate my costs down the line. Maybe if the market works like most things down the line, this will get rare, this will go out of print, whatever, it'll rebound, I'll be able to at least get my money back. That fundamentally at the core is the sunk cost fallacy. Your cost on it was $100. By not selling right away, you are choosing to spend more time, spend more opportunity cost by not recouping your money, and you're falling into a trap that I need to be able to make my money back. And in doing so, you're potentially costing yourself an opportunity down the line where you could use that $50. As much as it sucks, no one likes to feel taking a loss on something. It feels bad. When you look at something, it's like, man, I paid X amount for it. Now I'm only getting X minus 50%. That feels really bad, obviously. But this is a very, very common trap that most people fall into. It is something that is very, very common to feel. It's understandable that people would fall for this. And at its core, it's something that is a very expensive fallacy. This costs a lot of people, investors, businesses, just individual people, a lot of time, a lot of money, because they're refusing to acknowledge that this item A that they had purchased a year ago, it costs them $100 no matter what. On a bigger scale, a lot of people may look at this as, to take this one step further rather, a lot of people may look at this as, well, maybe we can do something to try and prop the value of this up. So on a bigger scale, if we look at investment firms, for example, corporations, a lot of people will sometimes try to put more energy and more effort into item A, right? So one of the most famous examples is the company that where WeWork is a subsidiary for. For those who don't know, WeWork is I'm trying to think how to best put this. Think of it as Uber for property. And what that means, it's not quite like Airbnb. Airbnb, kind of in a similar frame, not exactly the identical, but the way WeWorks is allow small businesses to basically lease out office space wherever they are, right? Let's say you're a small startup, you have 5 people, right? You need a standard office place to work. Who knows how long you're going to be there? Maybe in 6 months' time, your startup takes off and you need a bigger space. You're going to need space for 20 people in 6 months or whatever. WeWork allows you to basically lease out office space somewhere for a short period of time, or not a office space, workspace, business space, whatever, what have you, lease out for a short amount of time and be able to use it without necessarily being tied to your traditional commercial lease, where if you're trying to rent out office space inside a strip mall or something, they may want you to be signing a 5-year lease or a 3-year lease. And that's not something that necessarily fits for all these purposes, especially sometimes because maybe a workplace is expecting a surge of people for a small project. They need to be able to host these people for a small period of time. That's really where WeWork comes in. That's kind of how they operate. That's how their business model works. The parent company that bought WeWorks a few years back, they have spent over a period of, I want to say, about 2 years. My memory is a little bit fuzzy on this. I remember reading this, I want to say it's like an Economist. They've spent a ton of money trying to do what they can, changing marketing strategies, changing the game plan, changing how WeWork operates on a fundamental level, investing a ton of money into propping up WeWork, even though it was struggling financially. It was having a very, very rough time. I believe their IPO was a flop. But this company spent way, way more money trying to prop up WeWorks, because even after the acquisitions of WeWorks, the numbers were sliding. WeWork wasn't performing as well as people had anticipated, and this company was spending more money to try and prop it up. The smart thing would be to cut their losses, whatever that means. Instead, they probably spent an equal amount, if not more, acquiring WeWorks as they did trying to prop it up and trying to get it up onto its feet. That's an example of a company falling for a sunk cost fallacy. This is something that's documented. You can read about this online. That is sunk costs on a very, very large scale. Again, on a much smaller scale, it would just be using this asset, this item A that we acquired for $100, not selling it at whatever price, and thinking that you'll be able to recuperate the cost. This does tie in a little bit with opportunity costs. The opportunity cost is fundamentally whatever time, whatever energy, whatever money it took you to acquire this item. Most of us, at a business level, it's important to factor in labor. This is something that Michael Caffrey, when he was on a few weeks ago, if you want to listen to his interview, I would encourage you to do so. He explains how his business is centered around labor, about how labor dictates most of his business decisions. some of the things that it comes down to is when you have to manage employees, when you're managing a business, being able to take into account how much labor something is going to take is going to factor in ultimately to how profitable your business is. Opportunity costs, kind of the same idea. How much time it takes you to do something, you should be expecting a certain amount of return. But at its core, regardless of the outcome, your opportunity cost doesn't change. However much time you put into a project, even if the project ends up being a flop, that is the cost of that project. If you're buying merchandise, if you're buying goods, if this is something you're looking to invest in, your cost is however much money you put into that. A lot of people in this day and age, I see a lot of people not valuing their time. People aren't valuing their money. And in the end, I think this comes back to bite them. A lot of people think that that this industry, opening up a game store, is something that's hugely profitable. It's really not for the amount of energy and work it takes. I would argue that a lot of people who do have the skills, expertise to do so, most likely better served doing something else. For this very reason, you see a lot of game stores struggling. A lot of them are operated by people that don't have a good sense of business acumen. They don't understand a lot of these real world principles I'm talking about. And at the end of the day, that means that they fall victim to things like the sunk cost fallacy. And it costs them their business in the long term. This is not necessarily something to be ashamed of. This is just the reality of the situation. We see this on all levels. It doesn't matter if you're talking about trying to speculate on a bulk rare, again, because we see in the example of WeWork, right? These are corporations, these are holding companies that are spending billions of dollars. We've seen this in the past. The Concorde project, right? The first supersonic plane that could make a transatlantic flight in 3 hours in the 70s. Right, this isn't technology that's been able to be replicated since then. The technology is able to be replicated. It's been there. It's been done. Why don't we have a supersonic flight that crosses the Atlantic in 3 hours? Right. This was something that was done in the 70s. I think 70s, 80s, 90s. At some point, they cut the project off. And why was this the case? The operating costs were simply too high. A lot of the flights were very, very expensive. It was very, very cost prohibitive, both for the airline operating the flight to do so. It didn't make sense for them to be spending the amount of fuel and the cost of the planes themselves in order to be running this flight, especially for the amount of people, especially when considering how they were taking out flights with very few people on board, because, again, it was so expensive relative to the services being provided. Even then, a lot of these companies, they're still trying to operate these flights. They're holding on to hopes that with the purchase of these airplanes, that the cost would get cheaper, new technology would be discovered that would make it more efficient. The fuel was so expensive that it was really the death blow to the Concorde model, and that's why we don't see Concorde flights operate anymore. And even though, again, technology is there, now we're looking at more aerodynamic airplanes. And we have smarter airplanes as they were. They have developed better technology, better materials, right? All these things that come into play, we still don't see something like the Concorde being operated because it doesn't make sense. And taking a page out of the book, it wasn't worth it for those companies to just keep dumping millions and millions of dollars into this asset, right, into the Concorde plane, and try to make it work when early on the reality situation was they should have just retired the flights early when they realized that it simply wasn't a profitable venture. So that's kind of the nature, right? A more relatable example for most of us is reprints. This is something that we've fallen to all the time. The reality of Wizards, their the operations in today's day and age. Especially yesterday, we talked a little bit about the new era of Magic, the arena era, as we can call it. Reprints are going to be coming faster. They're going to be coming harder. We're going to see more of them. It doesn't necessarily matter if we see them in the form of Secret Lair, if we see them in the form of the list, a la Zendikar Rising set boosters, right? Reprints are a reality in today's world. There are some concerns about this, right? We've mentioned the concept of reprint equity. That's something that they may be burning a little bit faster than normal. There's going to be a point when they're simply going to, run out of good things to reprint. And that's going to be something that they have to deal with in the future. But in the context of reprints, right, it's easy to say, a lot of us have fallen into the example of, I have a card, I discovered it's going to get reprinted, the price went down, I didn't want to sell it, right? Like, this is something that I can easily say I've fallen for. Sometimes you have to cut your losses. A lot of the cards, when their value is baked into their reprint equity, right? Some cards hold up well. Fetch lands are doing very well. A lot of Zendikar Rising expeditions, the box toppers, they're actually still slowly continuing to rise. The playable ones, the fetch lands, Camera Souls, Prismatic Vista, what have you, they're actually holding steady or rising. Right, those are cards we've discussed in the past that have high reprint equity. It's unlikely their prices to be heavily impacted one form or another, but we look at something like True Name Nemesis, right? True Name Nemesis has more or less been on kind of a one-way street ever since it peaked back in 2013. When you combine factors of a Battle Bond reprint, Legacy kind of falling by the wayside, Legacy adapting and just having more answers, True Nemesis is gone from its high of like $40, $50, $60 down to like $6 now. And that's kind of a one-way street. Anyone holding on to it at one point, think if they held on to it when the price was at $20 or staring in the face of a Battle Bond reprint, you may be tempted to think at that time, True Name Nemesis is still a good creature, it's still a very unfair card, this Battle Bond won't do that much to it, the price will recover someday, right? And then you'd be stuck holding on to this because the price hasn't really gone up. If anything, True Name Nemesis has pretty much trended down or has trended down pretty steadily since the Battle Bond reprint in 2017 or so. My memory's a little hazy on that one. Again, concept of reprints, we see this all the time. Sometimes you have to understand that your card with a reprint simply will not recover in value. This is, again, not a hard and fast rule. This isn't always the case. Sometimes there are cards that do rebound. Those cards generally higher reprint equity. Those cards have a lot of demand beyond just one format. True Name Nemesis, kind of really exclusive to Legacy. It does see play in Cube, what have you. Is originally designed as a commander card, right? But most of its demand is from Legacy. Once that kind of fell by the wayside, the price of that card just has gone down, hasn't really recovered. Some other reprints do well, right? There's some reprints that dip briefly, right? If we just very much go back to our examples, Zendikar Rising box toppers, some of the fetch lands on release weekend, they had dipped a little bit once the big glut hit the market, the huge rush in supply from sellers trying to list them online right away. And then we started to see them rise again, right? That's an example of reprints actually doing well because there's more opportunities for people to buy the card. And people will want the new version, the new shiny or whatever. That being said, if you look at some of the older versions of these fetch lands, you go back to the Modern Master 17 and Zendikar versions of enemy fetch lands, pretty stable in price. They haven't really shifted up or down. They're actually relatively stable in price because this isn't necessarily the biggest reprint overall for fetch lands. So that's something that we have to be careful of. Sunk cost fallacy, something that we all experience. I can guarantee it's something that is a very, very strong emotion. That's why something that we feel very strongly about. We do see this a lot. There's something kind of in a similar vein of gambler's fallacy, right? The idea is that these, if I gamble enough over time, I'll eventually get lucky and make a big hit. I'll win it big, right? That's why you see a lot of people trying to win their money back, right? This is something, if you've ever been in a casino, if you're a gambler, this is something you've experienced. Fallacy is as kind of in the same vein as sunk cost fallacy. The idea is on a roulette wheel, right? If you play traditional American roulette, there are black spaces, red spaces, and 0, which is green, and double 0, which is also green. So in theory, if you just bet on black, you win slightly less than half the time. That's where the house gains its advantage. A lot of people fall into the rationale. It's like, if I just lose, $20 betting on black, I'll bet $20 again. In theory, it should be red, and I should, or in theory, I lose $20 because it landed on red when I bet on black. I should bet another $20. It can't land on red twice in a row, right? In theory, I should get lucky. It'll land on black this time. That's gambler's fallacy. Same idea. If the sunk cost is you lost $20, you should move on. That's gambler's fallacy is taking that a little bit further and thinking that they can get lucky, that they'll be able to basically make their money back. They just need to get lucky that one time. Of course, we all know the house always wins. The house edge is always going to be there. It's there for a reason. A casino is a business. They have to operate as a business. They wouldn't do it if it wasn't profitable for them. So on a small scale, you may get lucky. You may get your money back. You may, catch that lucky break, and you may break even or come out ahead. Most of the time, people go broke, right? This is the nature of a casino. This is why it works so well for them. This is why they continue to operate as a business. This is why most of them report billions in revenue per year, simply based on these fallacies. On sunk cost fallacy, on the gambler's fallacy. And that's just the reality of it, right? It's unfortunate. This is something that I'm sure I will continue to fall victim for at some point. Right? You have to be able to make the best decision you can with the information you have, and try to not let these things get in your way. And you have to understand, when it comes back to talking about opportunity costs, right? Your time has value, and your money has value, and you have to be able to maximize these in order to get the most return from your business or from your investment. Moving forward is anchoring. Anchoring is another cognitive bias that's fairly well documented. And what this means is, when you're anchoring, it means that you're relying too heavily on an initial piece of information to make future decisions. So the idea is that we have, I'm trying to think of a good example here. What a good example is we've seen something similar to this in the past, right? We know a card. I thought of an example. We can use Scoot Swarm, one of the green rares from Zendikar Rising. We can use as an example. Scoot Swarm, the original iteration, I've mentioned this in a past episode, is kind of a derivative of Scoot Mob. This was one of the rares from the original Zendikar. The original one was a 1-mana 1/1, and it says if you at the beginning of your upkeep you have 6 or more lands in play, or 5 or more lands in play, one of those, it gets +5/+5. And it essentially grows it. And people were convinced that this would be the next Tarmogoyf. It had a lot of the same symptoms. You could see that it's a small creature, it's green, it's undercosted, and has the potential to grow big very quickly. So I remember back in Zendikar, a lot of people were trying to hype up Scoot Mob and thinking that this would be the next coming of Tarmogoyf. Because it has a lot of the same patterns that Tarmogoyf did. This is textbook anchoring. This is people look at the creature. It's a small green creature that has the potential to go very big, and using it and thinking back to Tarmogoyf, same symptoms. It's a small green creature that has the potential to grow very big very quickly. A lot of people were caught up in that, and then, as we all know, Scoot Mob, basically bulk rare for the lifetime of its existence. It's been reprinted. That's not doing any favors. Scoot Mob will basically just always be a bulk rare. It's a definitively terrible card. That's not something that anyone would argue with nowadays. But this is where anchoring gets people caught up, and this is where it becomes a fallacy. People relying too heavily on the information given to them to realize that it's a bad card. People are relying too heavily on, this is going to be the new Tarmogoyf. This guy ties in with FOMO. No one wants to be missing out, right? FOMO, fear of missing out. We've talked about this in the past. This is something that people get caught up in quite a bit, especially now, today's day and age, especially with the current nature, how volatile the collectible market is. A lot of people seem to be really just high emotions, trying to buy what they can. No one wants to miss out. No one wants to miss out on the next big thing, right? Always, people are always looking and trying to catch that lucky break, because sometimes you catch that lucky break and you buy at the right time, you're gonna make a lot of money off your investment. If you buy something pre-spike, it jumps and you're gonna do well. No one wants to be missing out. This doesn't just apply to collectibles, right? People scour the stock market with a fine-tooth comb. Everyone seems to think that there's some hidden future blue chip out there that's in here. If I just buy it for pennies on the dollar, right, I can retire an entire wealthy man in a few years. And anchoring is really dangerous when you're trying to predict future events, when you're using it to affect your future plans, right? If you're relying too heavily on past information or the initial anchor point and trying to use it going forward, it's going to come back to bite you because you're not looking at it objectively. One of the things that's important to note is the fact that markets change. Markets nowadays are changing faster than ever. The collectible market, really not any different. A lot of people are trying to get in now. You have a lot of newcomers. You have a lot of new interested parties coming into the market because they realize that if there's money to be made, I should get in now as opposed to trying to wait and miss out. And a lot of people getting caught up in these high emotions. That's really the nature of investing, is how you can keep your emotions checked in at the door as opposed to bringing them with you. You always want to be keeping a level head and not falling to FOMO, not falling to anchoring, not falling to sunk cost fallacy, right? These are all things that people lose a lot of money over. So the example that I can relate, that I'm willing to share, is for those of you who may have followed me from Cartel Aristocrats, the previous podcast I did regarding MTG Finance for a long time. There was a stretch of time when I was really heavy into masterpieces. I was probably one of the first people to say that masterpieces are basically a modern day reserve list cards. I was buying very, very heavily into them because there was a point when these cards were just jumping up like crazy over the market because supply started dwindling on them. They were much harder to get compared to what I would consider box toppers nowadays. And there was a point when I was just buying them, and it was, in turn, I think I was probably responsible for a small run on the market. I think a lot of people started to catch on, and then once you started to see supply dwindling on a lot of these masterpieces, it meant more people buying them, which would further shorten the supply, which would cause the price to go up, etc. I was very, very confident in masterpieces. It was a good position to be in. I know I did very well with masterpieces, but there was a point when I was continuing to buy the masterpieces past the point where they would have still been good. And I think this started to come in around Amonkhet when we're talking about the invocations, right? This was kind of the third iteration of masterpieces. We had the original Zendikar expeditions from Battle for Zendikar. Second iteration was the inventions from Kaladesh, right? They're all artifacts. Amonkhet was kind of the third one. At this point, it was very clear that the Amonkhet invocations, they were starting to feel a little bit forced. They didn't have quite as a clean and clear theme to them as Zendikar was only lands, Kaladesh was only artifacts. It wasn't quite as clear now that Amonkhet really had a focus to it. There was a central theme. It was just kind of good cards that fit in with the plane, right? At its core, that's kind of what Amonkhet invocations feel like. It's very clear that there were diminishing returns, right? How long could it keep going? At some point, Wizards basically came out and acknowledged that Amonkhet invocations were probably a little bit more forced than they want to, and in order to keep them special, in order to keep them feeling unique, in order for the experience of I opened up a masterpiece to continue to feel cool, they said that they would discontinue them and bring them back in when it felt right to do so, as opposed to making them every set. So there was a point when they did away with that. I was still buying Amonkhet invocations. A lot of them have continued to do very well, but I was probably past the point, and masterpieces were probably past the point where they were doing well. then actually continue this with the next kind of iteration of masterpieces would be box toppers from Ultimate Masters, right? You got one box topper per box that you purchased. And then this was kind of the next evolution of masterpieces. You no longer got them inside individual packs, right? You got one per box. It was a very fixed rate. And that was how they appeared. So I was still buying Ultimate Masters boosters, box toppers at this point, thinking that they would exhibit a lot of the same properties, that there would be a resurgence in the demand for masterpieces. However, we're now starting to shift trends. Now we're looking at it kind of in a different way. Now it's becoming more clear that reprints are something that are going to do well. They're looking at new ways to explore the idea of alternate frames, of unique high-end pieces that people want. And now people are starting to be able to get pulled in different directions. One of the examples is Soul Ring, right? How many ways can you buy a Soul Ring? Right now, if you want a Soul Ring, you want the cheapest Soul Ring you can get, right? I can go to any of the commander sets on TCG Player or, your retail source of choice. Any of these sets, right? And you can buy just a basic non-foil uncommon Soul Ring, like $5, and it'll be shipped to your door in like a week or something. On the flip side, right, if you want to spend money on Soul Ring, let's say, you have an artifact deck, right? Soul Ring is going to be one of the cornerstones. Realistically, Soul Ring probably is the cornerstone of any real competitive commander deck. But if you want a cool Soul Ring, right, let's say you're trying to pimp out your deck, you have all foils, right? Your deck is foreign, whatever, you have original printings, etc., what have you, right? Like, what are your options, right? If you want to spend a lot of money on Soul Ring, there are a lot of avenues to do so, right? You have an alpha or beta version, right? It's like hundreds of dollars for those versions, right? The original OG art with kind of the bright circular flare thing, right? We're familiar with that one. If you want to spend your money, you can do so there. You have a Masterpiece Soul Ring, Kaladesh Invention, right? That was kind of the first iteration. You have a Judge Foil Soul Ring, I want to say from 2008 or so. It had the original art, but with the new silver modern metallic frame, right? And then, starting with last year, we had Command Fest, right? That was the introduction of a Command Fest Soul Ring. You could get that version in both foil and non-foil. And now going forward, right, with the release of Commander Collection Green coming out in about a month or so, we're gonna have another foil Soul Ring. Right, this is only one example. There's a lot of other examples, but now it's becoming very clear that there's demand for these blingy, alternate art, unique frames that are collectible that people want as a way to be able to express themselves. And now a lot of these cards are starting to get pulled in multiple directions. When the Soul Ring, kind of at the height of this, when I was really going deep on masterpieces, Soul Ring, that was one of two ways to get the foils. You could either get the Judge foil, or you get the masterpiece. That was it. Now we're starting to see that there's more options available. Demand, I think, for these cards would be going down. And this was kind of what was happening around the time of Ultimate Masters. It's very clear that box toppers were just the beginning of their ability to look at box toppers, alternate arts, full art in ways that they haven't before, right? We take a look at nowadays when we look at double masters, right? You have multiple ways to get the same art, right? It's available. There's alternate arts, there's full arts. A lot of these cards, there's simply too many ways to get a cool card out of it, for example, right? We look at Blood Moon. For a while, Blood Moon, you had the Dark version, you had 8th and 9th versions, and you had Mar Masters version, the original Mar Masters in 2013. That was the only ways to get Blood Moon. Blood Moon has been reprinted, right? If you want foil Blood Moon, there's an invocation for it. And now, with the addition of Double Masters, you have a full art version, box topper version that you can foil via the VIP packs. There's just so many ways to get these now that each individual printing of a masterpiece is no longer feeling unique. And I think the way this applies back to anchoring is I rely too heavily on my past knowledge that masterpieces, basically modern day reserve lists, I did well with them in the past. I will continue to do well with buying them. And for the most part, I still have some amount of box toppers, the Ultimaster box toppers. Some of them, I'm at the point where I've come to terms, right, this is kind of tying in with some cost fallacy. I should just sell them, get whatever money I can. A lot of them aren't going to rebound in value, right? That's kind of the reality of it. Whereas some of them I've done well with on, so it's kind of become a wash. Not that big a deal. But this is my example of understanding how anchoring affected that decision I made at the time. And if I thought about it more carefully, I probably wouldn't have bought as many of these Ultimaster box toppers as I did. The last real bias we'll kind of talk about, confirmation bias, right? This is something where you're selectively using data that supports your belief. Kind of in the same vein as anchoring, I saw that masterpieces did well in the past, and I would continue to buy them. And I was looking at selective ones, right? I could think like Soul Ring, sure, maybe it wasn't the most stable, but some of the more commander-centric masterpieces were still doing well. Some of the swords were still doing well. Some of the more legend type cards, right? Loyal Retainers, that card has always done well, right? So in the case of Ultimaster box toppers, I was targeting very heavily the EDH centric ones. So Balefire Dragon, that was one I probably went too heavily into. Machias, that was another one. Eternal Witness, these are all ones that I was using my idea that EDH centric masterpieces will do well. People like their big foils, their shinies, they're cool cards, they're impactful cards that are played in a lot of different commander decks. And I was using that knowledge, anchoring, to basically dictate how I would choose to go forward and buy these commander masterpieces or commander box toppers. So confirmation bias is something we're pretty similar with. This is one of the issues I have with social media nowadays. And this kind of ties into getting caught up in the FOMO. I think that's also a big part of it. A lot of people use Twitter kind of as an echo chamber. I think when you surround yourself with a lot of people who have the same ideas as you, who have the same mentality as you, who operate on the same axis as you, you start to kind of cut yourself off from other ideas, from other opinions. And I realize this is something that's difficult in today's day and age with so many people having opinions, especially with how often it gets political. But when you have an echo chamber, I think it's just as bad. I think you heavily limit yourself on some of the ideas you can come up with, some of the ideas that you can be exposed to. Because even if you don't necessarily agree with them, you have to realize that other people may have a different idea. And in the world of investing, this is a big deal. You have to understand why someone is going deep on a stock, on an asset, why someone's purchasing a bunch of these cards that you may not have, right? Having that idea just there is just as valuable, if not more valuable, than someone who necessarily agrees with you. Because if you just surround yourself with people who agree with you, you start to fall victim to confirmation bias, and you start to lock yourself off from potentially a whole new market, a whole new set of ideas, especially when it comes to investing, that you could be exposed to if you took the time to listen to someone that you may not necessarily agree with. So those are the three biggest biases that we're aware of: sunk cost fallacy, anchoring, confirmation bias. Right, these are all things that we can easily relate to. These are things that I'm sure we've all experienced in one form or another. Again, it doesn't necessarily matter if you're looking at this from a micro level. You just think about yourself and maybe speculations you've made in the past when it comes to flipping cards. Or if you're a small business owner and you're looking to take the next step, right? These are things that you need to be cognizant of, because at their core, right, they all have the same underlying principle, and they basically prevent rational thought, right? That's kind of what they do, and they are affecting any future decision you make based on things that happened in the past. And there's a good quote here. It's by John R. Knopfsinger. He is a researcher at the University of Alaska Fairbanks. He's written a few books. He's written a book, it's actually a textbook that's used in business courses. It's called The Psychology of Investing. There are a few other books that are a little bit easier to read. Behavioral Finance, What Everyone Needs to Know. This is a book that I haven't read in its entirety. It's something that I think it was at a library or something, some sort of library, some sort of collection of books that I had read excerpts from. And one of his books, one of the things that he writes, which I think is very important to think about, is yesterday's trade, today's emotion, tomorrow's mistake. And again, you can interpret that how you will, right? Yesterday, right? We experience this a lot, right? Usually, when we buy something, right? I imagine this is probably the cornerstone of buyer's remorse, right? This is something yesterday's trade, right? We exchanged something, we bought something, we made a deal that happened yesterday. Today, we get it, we're feeling the emotions from it, right? We're trying to ride the wave. Is this going to pay off? Is this a good decision? Did I make the right decision? And then tomorrow, it becomes a mistake because we didn't make the right decision, because we let decisions of the past, anchoring, right, confirmation bias, sunk cost fallacy, affect the decision. And then tomorrow we feel the regret, right? We made a mistake, and these fallacies, cognitive biases, affected how we made our future decisions, and that came back to bite us. So anyone who wants to dig a bit deeper into some of the things I've said, I would encourage you to take a look at him, John R. Nofsinger, Nofsinger. I encourage you to read him. He's a very interesting read. It is a little bit dry. There's a lot of technical things, but understanding how these cognitive biases work and understanding how these decisions shape up what we decide to do in the future regarding investment decisions, business decisions, is important. And I think he's worth reading. Maybe not its entirety. It's something you can skim through, but it should be something that is in most people's library. We touched a bit about opportunity costs, right? Just kind of sum all this up is you have to value your time, you have to value your money. There's only so much of you to go around. Most of us probably don't spend, our entire working day doing productive things. There are things that, will split up our attention, that will pull us in multiple ways. This is kind of the reality of it. If you're operating a business, you have to value your time, you have to value your money. Time, especially doing things that are not productive, things that don't give you a return on your time. If you're working on a project and you don't think it's going to pan out, just nip in the bud. A lot of people will force their way through. They'll complete the project in its entirety and then realize that project was a complete waste of time. They would have had the same result if they cut it off halfway through. They may be left with the idea that, man, maybe this project would have paid off if it worked through in the end. But more often than not, if it doesn't work, right, just nip in the bud. Instead of wasting, 2 weeks of your time, maybe you only waste a week of your time and the result's the same. This isn't something that I can stress enough. I'm always looking at ways to maximize my time, about how I'm spending my time better, about how I'm doing things that are productive, that are worth the time for the tasks I'm trying to do. I know a lot of people get caught up in this. The reality of the situation, and it's a tough pill to swallow for a lot of people. I think a lot of people just honestly may be better off working a normal job instead of trying to think that what they do here is productive and it's worth their time. Once you factor in the costs of doing these things, right? This is why I mentioned Gary Ray's book a few days ago, right? A 5-year path to middle class income, right? If you're looking to get rich off of this really isn't the way to do so. You have to value your time, you have to value your money, and people just often don't do enough of that. When it comes to investing, it's a little bit different. When I say value your money in the context of investing, right, how much return do you plan on getting, and how much money is it worth if that money would just be spent doing something else instead? And I see a lot of people make poor financial decisions. It's important to note, again, I'm not a financial advisor. If you're looking for something professional, I would suggest you talk to a real financial advisor. These are things that are my opinion. These are things that are my perspective. These are my experiences. This is what I can relate to. But what works for me may not work for you. This is important to note. With business owners, I tell them that they should make whatever decision works best for their business, right? Value their time, value their money. What works for me or what works for a different business owner may not work for them, and vice versa. You see a lot of people trying to follow and kind of fall into the steps of FOMO, of following others, of confirmation bias, right? All these things, they link together very intrinsically into understanding how their own business works. And when they don't do so, right, they fall in the trap of so-and-so is doing something, they're doing it right. I should be able to adopt that practice too, and I should be able to see success. And that's simply not the case. It's unfortunate, but this is something that is very, very commonplace. And opportunity cost is really the key there. You have to be able to value your time correctly. You have to be able to value your money correctly. And you have to make both of those things work for you. In today's market, it's also important to note that if you're looking to invest, especially in collectibles, you have to be knowledgeable. You have to be able to be flexible. You have to be liquid, right? These are all things that are cornerstones in investing. Remaining flexible, you have to understand that markets change very quickly. What's working before isn't working now. It's very possible that's the case. Something that was a good investment yesterday may not be a good investment today. This comes to stocks, right? Following news all the time, you have to see what's working out there in the real world. In the context of collectibles, right? A lot of people are looking at things and, right, you could very well fall in the same trap as I did. You could be wanting to buy masterpieces far past the point when masterpieces were still good to buy. Right, yesterday we talked a bit about the reserve lists, right? And I, again, honestly do think there will be a point in the future when Wizards of the Coast / Hasbro does away with the reserve lists. Do I think it's necessarily going to happen? At some point, I do think it will. I think it is a mathematical certainty. At some point, they will do away with the reserve lists. It may not be in 1 year, it may not be in 5 years, but at some point in the future, I think this is something that they will embrace, and this is something that they will do. We are in a different era of Magic. We talked about this yesterday. We are now kind of in the arena age, as it were. Magic is becoming more digital. It's becoming faster than it has in the past. Product is coming out faster. There's more products. There's more reprints. There's more releases. And what that means is that you have to adapt. A lot of the mantras that worked 5 years ago, 10 years ago, they just simply don't work anymore. We're now in a different time. We're in a different era. Things are operating differently. Markets are operating differently. You have to remain flexible. The people who suffer the most, businesses that suffer the most, are the people who are unwilling to change and who are unwilling to adapt with the modern day times. And you have to remain liquid, right? This is something that I've mentioned in the past. Everything has an opportunity cost. Keeping your assets liquid, being able to move in at a time when it may not necessarily be convenient for others, but you're able to do so, is how you capitalize on making the most return on your assets and investments. Because everything has an opportunity cost, right? Unless you have a literally limitless bank account, right, with infinite funds accessible to you, for the most part, money is a limiting factor for a lot of us. Being able to remain liquid, right? You don't want to tie up your assets and investments into something that you can't easily get out of. Because, again, opportunity costs. You wanting to hold on to this card, right, this spec, right, this asset, that's money that's not immediately liquid to you. What happens if you come across a good buy, a good opportunity, right? What happens if something walks into your door, if you're a business owner, and you don't have the means to buy it right away, right? You're costing yourself that opportunity. And although I've said in the past, there's always more opportunities to be had down the line, it's very possible that, this item may come back to you in the future, depending on how rare it is. It may come back to you in the future. You will have an opportunity to get another good buy. You will have the opportunity to find another investment or asset that you feel strongly about acquiring. Opportunity cost is still there. You do have to remain liquid if you are going to be successful. The real takeaway here is that everything is very fluid nowadays. Everything is very dynamic, right? Markets are very dynamic, right? Times change, habits change, spending habits change. All these are really the cornerstone of behavioral finance, of psychology, of the psychology behind investing, because things are moving faster and faster and faster than they were before. A lot of things are streamlined nowadays, and anyone looking in, right, if we just took a time machine and just went back 10 years, even 5 years, and we tried to explain a lot of the concepts that we know nowadays about the market, about some of these ideas, right, even 5 years ago, a lot of these would be completely foreign to us. But now, a lot of these things we've accepted as reality. And going forward, right, this is another tough pill to swallow. Things will continue to change. And if you're not at the forefront of that, if you're not trying to stay current, if you're not trying to stay relevant, right? It's very, very easy to fall behind and get left behind in dust while you have other colleagues, you have other businesses, you have people who are just surging way ahead of you. And lastly, I think the most important takeaway, and this is something, again, another tough pill for people to swallow, is never ever believe that you're better, superior, or smarter than anyone else. I know a lot of people, they feel like they've had that rush of success in the past before. They've done well with an investment, they've done well with a spec, they've done well with some sort of asset they've had, right? You should never think that you're able to stay ahead and stay ahead of someone else. All it takes, it doesn't matter how little someone else has, how little you may think of them. If they have one lucky break, that's enough for them to get ahead of you. And a lot of investors I know have lost money on the back of their pride. They couldn't let go of the idea that someone may know something that they don't. And this really goes back into being open, right? Being able to accept that someone else, there has to be a reason why someone else is buying into a spec, buying into an investment, buying into an asset that you may not be doing so. And being open to the idea that they may be onto something and they may be right and you may be in the wrong here. And being open is really how you're going to do well. There's no investor that gets things right 100% of the time. Anyone who does so, right, to be completely honest, they're just completely full of it. All of us had our fair shares of busts, right? Not every venture you take is going to be profitable. Not every investment you make is going to pay off in the long run. That's the nature of investing. Everything we do is a gamble, right? It's just a matter of how we can minimize that risk we take, how we can minimize this risk, how we can minimize the amount that we'll lose, right? And just learn from these mistakes potentially and help us make better decisions in the future. And I think this is really important, again, because when we've talked, right, I've had a bunch of interviews on, everyone has basically acknowledged that the pandemic has really completely changed most people's timeline. It's completely changed people's perspective on collectibles, right? Mark Salzberg, we discussed him yesterday a little bit. He's acknowledged that the pandemic has completely turned the collectibles market on its head. A lot of things are doing better than expected. Right at the beginning of the pandemic, a lot of us had the understanding expectation that collectibles would just completely tank in value. People wouldn't be playing paper magic. There would be less demand, less excitement for people continuing to buy wanting to buy cards for the future. And this was simply not the case, right? A lot of sales have just gone through the roof. We've seen card prices surge. Collectibles have surged in price. Assets have surged in price. And this is a matter of staying with the times. Right? And like this was, again, not what the majority of people thought. A lot of people had legitimately thought that they should sell things off before things go down in value. This did cause kind of a sell-off towards the beginning of the pandemic. You saw a lot of people that were selling out of things because, one, it could very well be that they needed to pay their bills to guarantee that their rent was covered, right? But a lot of people were selling to fear, and that simply proved to not be true. That ties in with markets changing and being liquid, right? If you were a buyer at the time and you had the foresight to think that people were at home, people need something to do with their money, there would be more expendable income, that buying these at this time would have been a good idea, you would have done very well. And again, it's important to note, that's why I encourage people to stay open-minded, of being able to learn from your mistakes. Never, ever, ever have the idea that you're better than someone else, because, again, even it doesn't matter how little you think of someone, that person, if they have one lucky break, they'll just be able to surpass you. And being able to listen to what other people think, listen to foreign ideas, listen to things that you may not be able to think of yourself, is really how you get ahead in this business, is how you get ahead in this industry, is how you make smart investing decisions. And that's really, I think, a key takeaway, not just in this itself, but in life. Being able to stay this fluid, being able to stay dynamic, being able to stay ahead of the curve is really how you're going to do well in more than just investing in business. So that being said, that'll just wrap up today's episode. As always, thank you all for listening. You guys can find me on Twitter at Edwin13. You can find the social media platforms for Vermilion PDX on the right. Wherever you are in the world, be safe. Have a good weekend. I know we didn't have an interview this week. I've been trying to line up a few interviews with different people. I'm just waiting to hear back. Some people have to get their schedule sorted out, but I do anticipate a return to interviews. That's something that we will continue to have on this channel in the future. So again, wherever you are in the world, stay safe. Thanks for listening as always, and we'll see you all next week.